Unit trusts and robo-advisors are two very popular ways for Malaysians to invest, but which one is better for you? So obviously this is a very individual decision, just like many other things in personal finance, but there are major differences. So after this video, you should know which one is better suited to your goals, and I'll also share my opinion on which one suits me better. Let's get started. First up, let's talk about how these two investments work, and we'll start off with unit trusts. So unit trust, the way it works is that it's a pooled fund managed by a fund manager. So think of it as like, let's say I want to invest my money, a few other people want to invest our money as well. We send it to a fund and they'll manage this as an investment. So this requires a human fund manager to make the decision, and it also is usually built more towards a specific niche. I'll talk more about this later on in this video. On the other hand, we have robo-advisors, and these can be considered, I guess, the newer kid on the block in this industry. So they are digital platforms that are also usually mobile first. Unlike unit trust, where we have a human fund manager, these guys, most of them at least, tend to use algorithms to help automate our portfolio management. In terms of how they invest, they are usually more broad-based, even though they can be customized as well. Again, I'll talk more about this later on in this video. But an example of a robo-advisor in Malaysia is Stashaway. If I remember correctly, they are one of the first to launch in Malaysia, so they've been around for quite a long time. And I've also used them for a long time as well. I think ever since 2018, I think, or 2019. So yeah, in today's video, in this comparison, I will be using Stashaway as an example for robo-advisors. Now, the first comparison we want to make is the assets that our money is invested in, and it's actually pretty similar. They both invest across a range of different asset classes like equities, which is stocks. They also invest in bonds and even alternative investments like gold. The major difference, I guess, is that robo-advisors tend to do these via ETFs. So yeah, stock ETFs, I guess you guys are familiar with, but gold and bonds, they also have ETFs as well, and robo-advisors tend to use them to get exposure to these asset classes. On the other hand, unit trusts, they can be more direct with their investments, so they can pick a specific stock that they want to invest in. A unit trust can say, I want to invest in Apple, whereas a robo-advisor like Stashaway don't invest in individual stocks. They tend to do it via ETFs only. So both of these are diversified in a sense, but there are also differences. Robo-advisors, they tend to be more broad-based, so they'll diversify investments across asset types, across geographies, as well as across different industries. For example, my Stashaway portfolio right now, it's invested into many different countries. They have ETFs in US, Canada, China, Japan, and many more. On the other hand, for unit trusts, rather than being broad-based, they usually have a specific niche that they're trying to aim for. So for example, there will be a unit trust for global technology companies, there will be a Malaysian growth fund, there will also be a Greater China fund. These are all just examples, but just looking at this, you'll realize that just by investing into one of these funds, it won't really give you a well-balanced portfolio. You don't want to just be invested in, for example, Malaysian stocks and call it a day, because you want to be diversified beyond that. So yeah, if you want to invest in unit trusts, you'll have to pick and choose a few different funds just to have a well-diversified, balanced portfolio. Moving on, let's talk about how these products manage our investments, and there is quite a big difference here. Like I said earlier in this video, unit trusts, they all have a human fund manager who will decide what to invest in and when to invest. I'm pretty sure they use a lot of technology, a lot of data to help guide their decision making, but at the end of the day, there is a human discretion element inside it. On the other hand, robo-advisors tend to take a more passive approach. As the name implies, robo-advisor is kind of like a robot. So they use an algorithm to guide the decision making, to guide the portfolio management. This is to minimize human intervention. There is no human fund manager who likes a particular stock and decides to invest in it. It's all pretty much automated. So I'm not saying one option is better than the other, but this is just important information for us to know. Because if you guys want to invest in a unit trust, then it does matter which fund you choose. You need to do the due diligence on these funds and their fund managers, because you need to make sure that they do have a good track record. At the end of the day, these are just human beings, and there are some human beings that are just better than others. We just have to accept that fact. Not all of these funds will perform well. In fact, a lot of them don't do that well. Moving on, let's talk about the performance and returns of robo-advisors versus unit trusts. So obviously, this is almost impossible for us to compare apple to apple, just because there's a lot of variable factors and it will vary from year to year. For example, if you are a Malaysian focused fund, then over the last 5 years, probably you would have done extremely bad. But this year, in 2024, you would have done pretty good. So I'll be talking more about the performance expectations, or basically what should we expect in terms of returns from these two investments. For robo-advisors, like I said, they tend to take a more passive approach, a more broad-based approach, which pretty much means the expected returns are in line with the market. If the stock markets are doing really well, like they are in 2024, then we should expect good performance from our robo-advisors as well. But if the stock markets are not doing so well, like in 2022, when global stocks were all just going down, then yeah, robo-advisors will suffer as well. Getting market returns, it's not actually a bad thing, you know? Even for myself, for my long-term investment portfolio, I'm pretty much all into ETFs, which basically means I am expecting market returns as well. And if you take an example, the S&P 500, over the last 10 years, the average annualized return is nearly 12%. And that is extremely good. Trust me, if I can lock in 12% a year now until I retire, I will take it, because over time, it will have a huge compounding effect. On the other hand, unit trusts, they are a bit more difficult to tell, just because, you know, like I said, it depends on the human being, it depends on the fund and how well they do for that particular year. If you get a good fund manager, then maybe they can outperform markets, or maybe they can deliver a higher risk-adjusted return for you. But if you get a not so good fund or a not so good fund manager with a pretty much bad strategy for the year, then yeah, they can underperform for a really long time. As an example, this year, the S&P 500 is up by 27.8%. I was just curious, so I went to a website and I searched up all unit trusts in Malaysia that only invest in US stocks. And what I found out was, yeah, none of them outperformed the S&P 500. So the best returning fund in this category has a return of 26% so far. So I guess they are pretty close to the S&P 500, but a lot of them were also below 20% for 2024. So yeah, they are trailing by quite a bit. Again, this is just one example from one year. Maybe in other years they will outperform. Maybe, you know, their strategy is just a bit different, but it is a bit concerning seeing so many of them underperform. And this is, you know, the reality of unit trust. There is just this element of variability. We don't know how well they will do. We just gotta hope that they have the right strategy. Just a personal example, my mom had a friend who convinced her to move some of her EPF money to unit trust, to her unit trust, I guess. She was selling it. This started in 2016, and by 2021, my mom found out that she made exactly zero from this investment. This is really bad, because if my mom just left it in EPF, she would have been better off at least, you know, 5 to 6% a year. But yeah, this just goes to show that not all unit trusts will do well. This is also especially painful for her, I guess, because after I told her that from 2016 to 2021, the US stock market had performed extremely well. You know, it was like a pretty big bull market. So for her to get 0% returns, it just really sucks. Now, let's look at StashAway's returns, and particularly their general investing portfolio at a 30% risk level. Since their inception in 2018, they have an annualized return of up to 10%. So this is actually pretty good, and they are diversified beyond the S&P 500. So obviously, if you invested only in the US, only the S&P 500, then your returns would have been higher. But in my opinion, at least, it does make sense for them to diversify beyond just the US. You know, things could change in the future. Even I would do that myself. So yeah, these are pretty good returns from StashAway. Now, let's compare the costs of unit trust and robo-advisors, and this is where I think there is a major difference. So let's start with robo-advisors, and they have two main fees. One is their management fees, and this is charged by the robo-advisors themselves. Looking at StashAway as an example, this fee ranges anywhere between 0.2 to 0.8% a year, depending on how much money you have invested. Then there's also the expense ratio of the ETFs. So this is charged by the ETF creators, I guess. Even if you invested into ETFs directly, you will still be charged this. It depends on which ETF you invest in, but on average, let's say it's 0.2% a year. So that is all the fees that robo-advisors charge. For unit trusts, there are also two different fees. One is, again, the same. It's a management fee, and they charge anywhere between 1 to 2% a year, depending on which fund manager it is. I opened a few just as an example, and it does seem like most of them are around 1.7 to 1.8%. Then, instead of the ETF expense ratio, because these guys, like I said, they don't really invest in ETFs, instead they have a sales fee, and it really depends on where you buy it from. The fee will, I guess, depend on where you buy these unit trusts from, but I've seen most of them set at 5%. This is actually a pretty big amount. Think of it this way: if you invest 1,000 ringgit every single month and you charge this 5% sales fee, in reality, you're actually only investing 950 ringgit because that 50 ringgit is a sales fee that they will have taken off right at the start. So what is the impact of these fees on our portfolio value after investing for quite a long time? I wanted to do the math, but I thought, it was easier to just ask ChatGPT. So here's the results. After 20 years of consistently investing 1,000 ringgit every single month, the difference in portfolio value for a robo-advisor versus a unit trust, just based off these fee assumptions, is 60,000 ringgit. That's 15%. That is a really big amount. And the longer the time period, let's say instead of 20 years, you do 30 years, and the more money you put, let's say instead of 1,000 a month, you put 2,000 or 3,000 a month, the bigger the difference will be. So yeah, fees really do matter, especially when it's as large as unit trusts are. Now, I've said this before. To me, fees don't matter. The only thing that matters is the net return after fees. If a fund that can give me 50%, 100% a year, then I don't care how much they charge me, right? But looking at historical performance and all that, it does seem very difficult to overcome this 5% sales fee. So yeah, I guess you just need to keep an eye out on it, make sure that they are at least delivering what you expect of it. Otherwise, it's time for you to consider either switching to a different fund or switching to a different investment product altogether. Finally, the last comparison I'm going to make is the accessibility and ease of use. So to me, this one, there is a clear winner, especially if you're someone who is tech savvy. Robo-advisors are just so much easier. To start with a robo-advisor, basically all you have to do is download the app, do some simple KYC, and then you just deposit money. Basically, you're done right from there. For unit trust, you will have to do it via an agent or via a bank, even though these days I am seeing more options to purchase unit trust online as well. But to me, the bigger difference in terms of accessibility and ease of use is when we're deciding what to invest our money in. For robo-advisors, again, it's extremely simple. All you have to do is a risk assessment, and then from there, they will recommend a portfolio for you. You can either accept the recommendation or you can change your risk level if you wanted to. But then from there, you're completely done. You don't have to decide, what ETFs you want to go for, what stocks you want to buy. Everything from there is completely automated. They will spread your investment across many different asset classes, many different ETFs as well, and you will have a diversified, well-balanced portfolio. Even when it comes time to rebalance your portfolio, to change things up, they will do that automatically for you and they'll send you an update. This is how StashAway works, and most robo-advisors, they work the same as well. For unit trusts, like I said earlier in this video, because they are more specific, because they have a niche, you will need to pick and choose which ones you want to go for. You can't just all into one unit trust because I guess it's not really that diversified. But yeah, your other option is to have an agent, I guess, or your financial planner to help decide which unit trust to go for. But then again, you'll have to make sure that you can trust them and that they will make the right decisions for you. Both options are fine. I'm not saying one is better than the other. Again, it's completely up to you. It's just that to me, robo-advisors are a lot more beginner friendly. They're just a lot easier to use as well. Having said all of that, having made all of the comparisons, which one should you choose? So if you're someone who's looking for a professional to actively manage your portfolio, then yeah, unit trust will be the better option. The other scenario for unit trust is that if you're someone who has good knowledge of the market and you want to choose a particular niche to invest in. Let's say you want to invest in China because you think it'll do well, then yeah, unit trust will serve that purpose better. Because like I said, robo-advisors, you don't really get to choose. You just pick your risk level and they will do all the investing for you. They will make decisions. But now that I say that, actually, StashAway, they do have this thing called flexible portfolio, which I use as well. It's basically you telling them, I don't want to use your algorithm. I don't want your robot to decide for me. I will choose my own ETF. So I guess, yeah, in a way, StashAway does give that option as well. But if you're someone who's looking for a more low cost, a more passive way to invest, you don't care about stock markets, you just want to invest your money, then 100% go for robo-advisors. Like I said, they will give us roughly market returns, so we won't massively underperform or outperform. We don't really have to track it either. We just continuously invest. Over the long run, we should be good to go. Personally, I am more of an ETF guy for my long-term investment portfolios, so I do tend to lean more towards robo-advisors. I have been using StashAway for quite a long time now, like I said, and I think the ease of use is just too good for me. All I have to do is literally just set up my automated investments. Every single month, I deposit 500 ringgit, 1,000 ringgit, and I'm good to go. I don't have to do anything beyond that. I'll just check in a few years' time. Even though I am very active in stock markets, I do track markets globally because I am a trader for a living. For my long-term investing portfolio, I just want to keep things simple. For unit trust, I have tried it out, I think a few years back. Every once in a while, I'll just have a look at unit trust. but I have never put in massive amounts of money into it because I've just never been a huge fan of it. Maybe things will change in the future, but for now, I will stick to Roboadvisors. By the way, if any of you guys want to sign up for Stashaway, then you can use my link. I'll leave it down below in the description. You will get 50% off your management fees for the first 6 months. So let me know down in the comments below, which one do you prefer? Roboadvisors or unit trust? Thanks for watching this video to the end, guys. Give me a huge thumbs up if you enjoyed it and subscribe to my channel if you haven't already. See you guys in the next one. Peace out.